Greetings. Welcome to Liberty Call. I am Raymond Dahlman, your humble host, and it is Thursday, October 12th, 2023. Hope everybody's having a fantastical day out there. It's a bit gloomy here in Colorado. It's been overcast most of the day, but we got cold weather heading our way, so does not look exciting. So I don't mind the cold weather, but when it's overcast, it's just, yuck. Anyways, like I said, hope everybody's having a good day out there. If it is your first time watching Liberty Call, if you could do me a favor, if you could give me some thumbs up, like, share, subscribe, follows, and hit the notification bell. Let's go ahead and get into the numbers for today, folks. Dow Jones was down 0.51%, 173 points, closed at 33,631. SP 500 was down 0.62%, closed at 43.49. NASDAQ down 0.63%, closed at 13,574. The VIX was up 3.73% today. It's currently at 1669. Canada was down 0.83. Brazil up 0.27. Oh, actually, Brazil was closed. And Mexico was down 1.26%. Over in Europe, Germany was down 0.23. The UK was up 0.32. France was down 0.37%. The Netherlands up 0.51%. Spain down 0.26%. Italy up 0.26%. Switzerland down 0.53% and Portugal down 0.9%. Russian exchanges split today. MOEX down 0.61%. The RTSI up 2.11%. And the overnights in Asia, the Nikkei in Japan was up 1.72%. Australia up 0.04%. New Zealand up 0.01%. In China, the Shanghai was up 0.94%. The Shenzhen Component up 0.83%. China 50 up 0.85%. DJ Shanghai up 0.91%. Hang Seng up 1.84%, and the Taiwan weighted was closed. All right. So from what I read, and we're going to talk about, actually we're not, there was a bond auction today, which really did not make the markets real happy. And, the markets went into the red after that. So if you want to do some reading on that, you can go to investing.com. They got some articles on the bond auction that was held today. All right, let's go ahead and get to the market recap. SP 500 slips as Treasury yields regain momentum on stronger inflation and jobs data. All right, the SP 500 experienced a decline as rising Treasury yields, fueled by higher than expected inflation and ongoing strength in the job market, diminished expectations that the Federal Reserve has completed rate hikes. September's consumer price index rose by 0.4%, surpassing expectations with an annual rate of 3.7%. The core measure, excluding food and energy, held steady at 0.3%, but concerns about the, quote, uncomfortable, slow, quote, unquote, pace of improvement lingered, according to Stifel. The labor market showcased some resilience, with initial jobless claims falling short of expectations. Jeffries noted that the claims did not indicate a notable increase in layoff activity. Despite the strong labor market, the probability of a rate hike in the upcoming month remained low at 12%, according to Investing.com's Fed Rate Monitor tool. Treasury yields resumed their upward trend, with the yield on the U.S. 2-year Treasury surpassing 5%. Delta Airlines reported Q3 results exceeding analyst estimates, but lowered its full-year revenue outlook, citing increased fuel costs, leading to a more than 2% drop in its shares. Ford faced a 2% decline due to an unexpected strike called by the United Auto Workers Union at its profitable Kentucky plant. Stellantis, down 2%, engaged in talks with the UAW to avoid further disruptions at its plants. Birkenstock holdings continued to decline, falling 5.7%, following a lackluster stock market debut. Disney and Comcast initiated the sale process for Hulu, hiring Morgan Stanley and JP Morgan to value the streaming site. The move is tied to the November 1 deadline, requiring Disney to buy the remaining 33% stake in Hulu from Comcast under the 2019 put-call agreement, with a guaranteed sale price of $27.5 billion for Comcast's stake. All right, so that's everything going on in the markets for today. Let's dive a little deeper into the inflation. Surging rents lift U.S. consumer prices, underlying inflation grinding lower. All right, U.S. consumer prices rose in September, primarily due to a surprising surge in rental costs, while underlying inflation pressures continued to moderate, easing concerns that the Federal Reserve would raise interest rates in the upcoming month. The annual increase in consumer prices, excluding volatile components like food and energy, was the smallest in 2 years, signaling a slowdown in inflation. The report indicated a 0.4% increase in the consumer price index last month, with a notable 0.6% rise in shelter costs, accounting for over half of the overall increase. Despite these concerns about a tight labor market, the Fed's 2% inflation target may face a challenging path, potentially leading to an extended period of elevated interest rates. Factors such as higher U.S. Treasury yields and the ongoing conflict in the Middle East are likely to dissuade the Fed from further tightening monetary policy. That's a pipe dream. The overall trend in inflation remains positive, but the Fed may consider extending its pause into December, given the recent increase in longer-term rates, according to Olu Sonolu, head of U.S. regional economics at Fitch Ratings. While the CPI increased 3.7% year-on-year in September, down from the peak of 9.1% in June of last year, the core CPI, which excludes food and energy, rose 4.1% on a year-on-year basis. The report highlighted the notable increases in owner's equivalent rent, a measure of the amount homeowners would pay to rent their property, which could be a key factor affecting inflation in the coming months. So it looks like, while they've tried to put a positive spin on the inflation numbers looking pretty good, they're still not very good, unfortunately. So it's still running about 100% more than what they would like. Their goal is a 2% target, and right now it's running up near 4%. So again, for anyone who's out there hoping that the Fed was going to come riding to the rescue and, drop rates back down to zero like we've had since 2009, it's just not realistic. So, all right, last up, article here from Zero Hedge. It's titled "The Stock Market Sits on the Edge of the End of the World." And this was submitted by QTR's Fringe Finance. Get my notes here. All right. The author suggests that the world is on the brink of unprecedented volatility due to a unique combination of geopolitical instability, flawed monetary policies, and domestic division. Key factors contributing to this volatile situation include the historically high U.S. debt levels, with interest rates at their highest alongside a massive $33 trillion debt burden. The government's failure to address the escalating deficit is seen as exacerbating the economic challenges. The market's artificial inflation through passive ETF investments, massive COVID-related liquidity, and manipulation of options market is highlighted. The author argues that the market surge, even in the face of inflation and geopolitical tensions, is not a result of legitimate bids for stocks, but rather a consequence of liquidity injection and speculative activities. Geopolitically, the author emphasizes the growing alliance between Russia, China, India, and South Africa to conduct business outside the Western banking system. Simultaneously, conflicts in Ukraine and the Middle East, coupled with the U.S. involvement and fiscal commitments, contribute to unprecedented global tensions. The strained relations within the U.S., intensified by issues like the Israel-Hamas conflict and divisions over movements like Black Lives Matter, add to the uncertainty. The author expresses concern about the potential for a global conflict, stating that the world seems closer to a third world war than at any recent time. The domestic potential division is characterized as reaching a breaking point with heightened social unrest. On an investment note, the author maintains a belief that in the value of precious metals and gold miners, suggesting that they offer a hedge in times of uncertainty. Despite the expressed hope for a return to normalcy, the author sees the setup for sweeping changes and volatile shifts. The U.S. Monetary and fiscal policies, geopolitical tensions, and domestic divisions as key drivers. The warning is given that the world is on the cusp of dramatic change, and the author urges readers to consider these factors in their financial planning. I would agree. The world has fallen apart, and being prepared now, it's like I learned in Cub Scouts, being prepared is the Boy Scout motto. And, you can never prepare too much for the future, whether or not it's saving for your retirement or the stupid things that our governments do, being ready and, being nimble and able to, roll with the punches is very, very important. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I will talk to you next time. Adios.